Hi everyone, Momo Traders here, and I'm officially back. I took 2 months off from YouTube, and now I'm back. I'm still trading, and I'm gonna record videos and update you on some video lessons and Excel, as well as some of my trades. Now in this video, I'm gonna share with you 5 key takeaways for me personally in 2021. I started trading in 2020. And 2021 was very different from 2020. As you know, trading is a really never-ending process of working on yourself, working on your strategies, improving your strategies. And these are the 5 main things that I've learned by trading in 2021. Number 1, there's a big difference between your win rate and your performance. Now let's say you have a strategy that has 80% win rate. When you win, you make 400 bucks, but when you lose, you also lose 400 bucks. If you do it this way, it's really hard to still grow your account. And sometimes you have a strategy that has very specific conditions, and so your win rate is much higher than your average win rate. Most of the time, I would just risk a lot more on these kind of trades. And it's true, you can risk more, but there is a catch. It only works if this pattern under these perfect conditions, if it goes your way. So let's say you trade double size, and then you should be making double money. But the problem is, let's say you open a trade and right away it goes against you. In investments, it's called confirmation bias. Look at your data and you see, okay, these are perfect conditions, so I'm down like 400 bucks, and I'm gonna just keep this position until, let's say, it goes to $1,000, which is my ultimate risk for, like, let's say, perfect conditions. What I've learned is it's not always the best way to do it. What I would do, I would add to these trades. So let's say I'm already down 400, 500 bucks, and my total risk is 1,000, and conditions are perfect, and I look at my data, everything looks perfect, and I would just be adding on the way up. Let's say I was shorting and I'm adding on the way up. So what I've noticed, it's not necessarily the best idea to do it, because you're being influenced by this confirmation bias. You're looking for confirmation in your own data to justify your bad trade. And then when you finally exit the trade, you're taking the loss that is much, much bigger than you would ever thought. So now in this year, what I'm gonna do different, I'm actually gonna focus more under which condition I'm losing the most money and under which conditions I'm making the most money, and based on that statistics, I'm making sure that my average win for whatever pattern it is greater than my average loss, so that I can grow my account much faster. Now the key takeaway number 2. So for the second one, it was actually pointed out by one of my students. Now this guy is really smart. He does a lot of research about stocks, about different floats, market caps in different sectors and different strategies. And whatever I taught him, he actually took it further, and he breaks it down. He tries to see any other edge within these strategies, and we always share almost every day, like, our trades and what we do, like any kind of ideas we have, how to improve on trades and strategies. So number 2 is use compounding method when you size into your trades. So what does that mean? Now I'm not gonna talk too much about the compounding and like what it is, because you can easily Google it. And so what compounding interest is basically when you take $1,000 and let's say you get a 10% increase at the end of the year. So you have 1,100, and then a year after that, your starting point will be $1,100, and 10% on that is going to be $110. So $110 will be added to the sum at the end of the second year, and so on. And so what it does, it basically almost exponentially, it lets your account grow almost exponentially. And so that's a really, really powerful tool, because before he actually pointed it out, I was trading, I would have like a fixed stop loss, and it was $1 stop loss. So, but if I know if all of my strategies are profitable, then it makes sense to size in more and to use the exponential sizing strategy for this, because then my account will grow much faster, or at much faster rate. Now, for the number 3 is study your data, find the outliers and study the outliers. And I wish I knew it in 2020 when I was just starting out trading, because pretty much I knew all the strategies. I had some statistics, but I didn't know, like for example, if you have a micro float, let's say a stock that has a 10 million float, and most of these stocks, like why do they go up 100, 200, 300, 700%? You know, and then throughout like the year, you see you look at your performance, micro float stocks, and what happens is you trade them. Let's say you short these micro caps, and then you see if you're making money or if you're losing money. And what I found out, that it's extremely hard to make money shorting these micro floats, especially if the market is kind of hot, like let's say winter or summer or fall. It's really hard to short into these, but I would still short it, and I wasn't doing so well with the micro float. And then I found this the outliers, so I knew the micro float stocks are hard to trade. I opened my Excel and I spent like 10-12 hours researching every kind of possibility with micro floats and how to find and how to short them. And so after this time, it was actually a collective effort. It's me and a few other students. They were pitching their own ideas too, and we actually found the way how to trade them and how to trade them profitably. And not just that, it's a safe trade, and if you use it this way, you basically get 1200% return in the last few years, you know, something like that, if you trade it the way that we found. The takeaway number 4, so follow statistics and lean not on your own understanding. Now, it's extremely important because actually, as I'm recording this video, I've made a mistake. I've made a mistake today, and I could have made a few $1,000s profit, and I didn't. I actually lost $4. You know, because, you know, as a stats trader, I look at my statistics and then decide if I want to trade this stock or not. But today, my judgment, or I should say my prejudice, took over. That hindered my performance in trading. So today it was the stock, the HUDI. I'm sure a lot of you guys saw it. So this stock went down, so it dropped 60% or 65%, something like that, from the open. And then I just went to Finviz and I looked at the stock and I saw it's a micro float, it's a larger cap, so it was like 100 million cap, and the micro float, so these can really spike. Then I saw that this stock was based in China, so it's a Chinese stock, so that was a problem. Now, I know what you guys will say, and it has nothing to do with the prejudice towards the origin of a company or anything like that. But yesterday, a stock, PETZ, the ticker, this stock dropped 80% from the open, and it never bounced. And I lost money on it. I think I lost around a few $100 on it. I was in and out really quickly, so I minimized my losses there. But PETZ dropped from the open, and it never bounced. It just kept dropping and dropping and dropping. And then I looked at my data, and it makes sense to buy these stocks after they drop 80%, but which I did, and I lost money. And today it's another Chinese stock that dropped 60% or 65% from the open. So that's why I was hesitant about dip buying this stock, because, you know, I don't want to lose. I don't want to be fooled twice, you know. So, but then what happened was this HUDI stock spiked 120% from the drop. So it dropped to $8, and it went all the way up to $25. So it's 200% gain, something like that. Yeah, that's the lesson that I've literally learned today. You know, just lean on your statistics. I have hundreds and hundreds and hundreds of these data points, and I should have just traded it, and I didn't. You know, so that was my mistake. So, and missed profit, it's not a loss, but it's still missed profit. And the last point, which is the most important, and I can't stress how important it is. It's important for me, and I guess it would be very helpful for everyone else. So keep trading simple. Don't overthink trading. You know, if you're a strictly statistical trader, keep to your statistics. You know, if you're a fundamental trader or you look at PE ratios, which is, in my opinion, it's completely useless, stick to that, but find what works for you, and don't try to mix them two, because there's this thing that's called confirmation bias. Confirmation bias, and confirmation bias is when you open a trade and you're losing money on the trade, and you try to find the news that confirm your entry in this trade. You see, and it's very dangerous, because especially if you're a new trader, there's so much information, and what people do when they open a trade, they just they go to Reddit, they go, if you have a Webull, there's a chat and people read all these comments, which are completely useless. And people don't look for the information. They're not just looking for the information about the company or something. In reality, they're looking for information that confirms their entry and goes along with their way of thinking about the stock. And that's why it's so very dangerous. And for me personally, I try not to read the news about the company at all. Like, I trade statistics, and that's what I do. And I don't ever want to read any news. And every time I made a trade based on news, I've lost money every single time. So that was it. And I don't know, honestly, so there's a book, you guys, probably some of you know it. It's called Momo Traders, and there was this one guy who was, so most of these guys, so they basically, for this book, they interviewed tons of traders, one of the best traders in the US, and there were statistical traders, algorithmic traders, and there was only this one guy who had a PhD in finance, and he actually knew how to read the statements and how to make a decision whether he would short his stock or he would buy it. But you need like 15-20 years of experience, and you need a PhD in finance, which most of people that I know, including myself, don't have. So that's why I don't read news at all, like, because I remember a few weeks ago there was a stock that they were under, I don't remember the ticker, so if you guys remember the ticker, please put it in the comments below. But there was a stock, they were under SEC investigation. So complete garbage. It was down like 40% from on the pre-market, and it had a nice spike in the morning. So, and I thought it would be a great idea to short it on this spike. And so what happened was the stock spiked another 150% for no reason, and they were under SEC investigation. Like, think to yourself, like, can it get any worse? If your company is under SEC investigation? No, it can't. But still, the stock spiked 150%, and then it spiked more the day after that. So I didn't lose much money at all. Like, I set my risk around like 3% of my equity, so it was not a big loss. But still, when market is boring and there's nothing to trade, and you start looking at the news and thinking now you can actually short these fundamental plays, even though you don't know how to trade fundamental plays, this is when you make a mistake and you get squeezed. So these were the top 5 takeaways from this 2021 trading year. I still made solid profits. I think I only lost money in October and November, so 2 months out of 12 I've lost money, and there were a few months where I just made like a little over like 1,500, something like that. But besides that, my year has been pretty good. And I'm always developing my strategies and looking for ways how to improve them. So if you guys like this video, please hit the like button and ask me any questions in the comments below. And I'll see you guys next time.